By early 2021, Robinhood had become one of the fastest-growing financial apps in the United States, while millions of younger retail investors were using the platform to trade stocks, options, and cryptocurrencies directly from their phones. Unlike traditional brokerage firms that often charged trading commissions and operated through more complex desktop-style platforms, Robinhood built its entire system around simplicity, instant access, and frictionless mobile trading designed specifically for newer retail investors. Users could open accounts quickly, deposit money digitally, buy stocks almost instantly, and trade directly through a mobile interface that made investing feel faster, easier, and far more accessible than older brokerage systems. The company primarily generated revenue through a system called payment for order flow, where market-making firms paid Robinhood for routing customer trades through their trading infrastructure. That model allowed Robinhood to advertise commission-free trading while aggressively expanding its user base during the late 2010s. At the same time, the platform made options trading, margin investing, and rapid market participation available to large numbers of inexperienced retail traders who previously had far less direct access to those parts of the financial market. By 2020, several larger shifts inside the economy started accelerating Robinhood's growth even further. Pandemic lockdowns kept millions of people at home, stimulus money increased retail liquidity, financial markets became highly volatile, and online investing communities across Reddit, YouTube, TikTok, and social media platforms started attracting enormous attention. Robinhood sat directly at the center of that environment because its mobile-first design made rapid trading activity feel immediate, social, and constantly accessible. As user growth exploded, trading activity surged across meme stocks, speculative technology companies, options contracts, and highly volatile market positions that generated increasing engagement across online investing communities. From the outside, the system looked extremely powerful because Robinhood was adding millions of users, processing enormous trading volume, attracting major investor funding, and becoming one of the defining financial platforms of the pandemic-era retail investing boom. However, underneath the growth, the company was becoming increasingly exposed to a much deeper layer of financial infrastructure pressure that most retail users using the app could not see. Robinhood controlled the user experience on the surface, but underneath every trade sat clearinghouses, collateral requirements, settlement systems, liquidity obligations, and market risk protections designed to keep the broader financial system stable during periods of extreme volatility. The problem was that the speed of app-driven retail trading activity was beginning to scale much faster than parts of the underlying market infrastructure had originally been designed to comfortably absorb. The pressure building underneath Robinhood accelerated dramatically during 2020 as pandemic lockdowns, stimulus payments, market volatility, and online investing culture collided at the same time. Millions of younger retail investors entered financial markets during that period because trading suddenly felt more accessible, more social, and far easier to participate in through mobile platforms than traditional investing systems. Robinhood became one of the largest beneficiaries of that shift because the app removed many of the barriers that had historically slowed retail participation inside stock markets. Users could trade frequently, access options markets quickly, receive instant account funding, and monitor constantly moving stock prices directly from their phones throughout the day. At the same time, online investing communities across Reddit forums like Wall Street Bets, YouTube trading channels, Discord groups, TikTok finance creators, and social media feeds started amplifying speculative trading behavior at enormous scale. One of the biggest targets during that period became GameStop, a struggling physical video game retail chain that many hedge funds believed would continue declining as digital game downloads increasingly replaced physical retail stores. Because of that expectation, several hedge funds heavily shorted GameStop stock, by betting its price would continue falling over time. Retail traders inside online investing communities increasingly viewed those large short positions as an opportunity to force a short squeeze by aggressively buying shares and call options against institutional investors betting on the company's decline. As more retail traders flooded into GameStop and other meme stocks, rapidly rising prices triggered massive online attention that pulled even more participants into the frenzy across social media platforms. That created a powerful feedback loop where rising stock prices generated more viral momentum, which attracted more traders, which pushed volatility even higher across already unstable positions. Robinhood's trading volumes exploded during this period, while the company rapidly added new accounts and processed enormous levels of retail activity moving through the platforms simultaneously. Externally, the system still looked extremely successful because retail enthusiasm, app downloads, market engagement, and investor excitement were all accelerating together. However, underneath the surface, the infrastructure supporting those trades was beginning to experience mounting pressure as clearinghouses responsible for guaranteeing trade settlement started facing dramatically increasing market risk exposure during extreme volatility. As retail trading activity accelerated during late 2020 and early 2021, Robinhood's platform increasingly became associated with a new style of app-driven investing behavior that many regulators, market observers, and financial professionals started watching closely. The app's design emphasized speed, simplicity, constant engagement, and frictionless participation in ways that felt very different from traditional brokerage environments built around slower and more deliberate investing behavior. Users received instant notifications, real-time price movements, simplified trading interfaces, and rapid access to options markets that previously felt more difficult for inexperienced retail traders to enter. At the same time, social media communities amplified emotional momentum around highly volatile stocks by constantly sharing gains, screenshots, memes, and aggressive speculative trading strategies across online platforms. This created an environment where market participation increasingly felt tied not only to investing, but also to entertainment, online identity, competition, and viral community behavior. Robinhood's growth accelerated directly inside that atmosphere because the easier trading became, the more frequently users interacted with the platform throughout the day. The company continued expanding rapidly as trading activity, payment for order flow revenue, options volume, and investor enthusiasm all surged simultaneously during the height of the retail trading boom. However, the same factors driving Robinhood's explosive growth were also increasing instability underneath the system. Highly leveraged options activity, rapid trading behavior, and concentrated volatility across meme stocks created much larger settlement risk exposure throughout the financial infrastructure supporting those trades. By January 2021, millions of retail traders were now participating simultaneously inside one of the most unstable and emotionally overheated trading environments modern financial markets had experienced in years, while critical infrastructure underneath the system was beginning to experience mounting strain. By January 2021, the pressure building across the system reached a level that suddenly exposed how unstable the underlying market infrastructure had become during the meme stock trading frenzy. GameStop became the center of that escalation because millions of retail traders aggressively bought shares and call options against hedge funds holding extremely large short positions, betting the stock price would continue falling. GameStop had traded below $20 earlier in January before volatility rapidly accelerated during the short squeeze. As buying activity exploded across Reddit communities and social media-driven trading momentum, the stock surged violently and briefly climbed above $480 intraday during the peak of the frenzy. That rapid increase immediately created massive pressure on hedge funds that had heavily shorted the stock, because short sellers eventually needed to buy shares back in order to close positions and limit growing losses. The higher GameStop's price moved, the more pressure short sellers faced to buy back shares quickly before losses became even larger. At the same time, aggressive options trading activity forced market makers selling those options to purchase additional GameStop shares in order to hedge their own risk exposure as prices surged upward. That created a powerful feedback loop where rising prices triggered more buying pressure, which forced additional short covering and hedging activity, which pushed prices even higher across an already unstable market environment. Several hedge funds suffered enormous losses during the squeeze, while Melvin Capital required emergency funding support after losing billions of dollars during the volatility event. Robinhood sat directly at the center of that activity because enormous amounts of retail order flow were now moving through the platform every minute during the height of the frenzy. However, underneath those trades sat clearinghouses responsible for guaranteeing that stock transactions between buyers and sellers would still settle correctly, even if one side of the trade failed during extreme volatility. As meme stock volatility exploded, clearinghouses suddenly faced dramatically higher financial risk exposure because the probability of failed settlements and market instability increased sharply during the trading frenzy. To protect the broader market system, clearinghouses began demanding much larger collateral deposits from brokerages like Robinhood in order to guarantee that those trades could still settle safely while volatility continued accelerating across the market. Externally, millions of retail traders still believed they were simply participating in a massive social-driven market event, but underneath the surface, the financial infrastructure supporting that activity was beginning to experience one of the most intense stress events retail trading systems had faced in years. On January 28, 2021, Robinhood suddenly restricted users from purchasing several heavily volatile meme stocks, including GameStop, while still allowing many users to sell existing positions. For millions of retail traders participating in the frenzy, the decision immediately looked like market manipulation designed to protect hedge funds losing billions of dollars during the short squeeze. Public outrage exploded across Reddit, Twitter, YouTube live streams, Discord communities, and financial news coverage within hours as users accused Robinhood of betraying the retail investing movement that originally helped fuel the platform's explosive growth. However, underneath the public controversy was a much deeper infrastructure crisis unfolding inside the financial system itself. Most Robinhood users experience trading as an instant mobile process where stocks appeared to be bought and sold immediately through the app. But underneath the surface, stock trades in U.S. markets still required settlement processing behind the scenes that could take additional time to fully complete between buyers and sellers. During that settlement period, clearinghouses acted as financial middle systems, guaranteeing trades would still complete correctly, even if one side of the transaction failed during extreme market volatility. That system normally operated quietly in the background during ordinary market conditions, but during the GameStop frenzy, volatility became so extreme and trading volume became so large that clearinghouses suddenly faced dramatically higher risk that unsettled trades could fail before completion. To protect the broader financial system from instability, clearinghouses began demanding much larger collateral deposits from brokerages like Robinhood, processing those trades. Those collateral obligations reportedly surged into the billions of dollars extremely quickly, as meme stock volatility accelerated across the market. Robinhood suddenly faced a severe liquidity crisis because the company did not have unlimited capital available to continuously absorb rapidly escalating clearinghouse requirements during one of the most volatile retail trading events in modern market history. The restrictions were not simply about slowing user activity. They were part of an emergency effort to reduce settlement risk and collateral exposure, building underneath the platform, while Robinhood scrambled to stabilize liquidity fast enough to keep operating. At the same time, the company rushed to secure emergency funding from existing investors and ultimately raised several billion dollars within days in order to strengthen its financial position during the height of the crisis. For many retail traders, the event permanently damaged trust because the platform that originally marketed itself around democratizing finance had suddenly restricted purchases during the exact moment users believed they finally had momentum against institutional investors. After the trading restrictions, Robinhood faced one of the most intense public and regulatory crises in the company's history as users, politicians, regulators, and financial commentators all began questioning how modern retail trading infrastructure was actually operating underneath the market. Millions of retail traders believed the system had been manipulated because users were suddenly prevented from buying certain stocks during the exact moment prices were rising most aggressively. At the same time, lawmakers and regulators started focusing on several deeper questions connected to the structure of modern app-driven investing platforms. Critics increasingly questioned whether frictionless trading systems, instant options access, and payment for order flow incentives had encouraged excessively risky trading behavior among inexperienced retail investors. Others focused on the hidden infrastructure underneath the market itself, including clearinghouses, settlement timing, liquidity requirements, and the concentration of risk exposure created during extreme volatility events. Many retail users only discovered during the crisis that stock trades do not settle instantly, even though trading apps make transactions appear immediate on the surface. Behind every trade sat a settlement system involving brokerages, market makers, clearinghouses, collateral requirements, and counterparty protections designed to prevent financial instability if transactions failed during volatile market conditions. The GameStop frenzy exposed how rapidly app-driven trading activity could suddenly place enormous pressure on those systems once millions of retail traders started moving together through highly volatile positions simultaneously. Robinhood executives were called before congressional hearings where lawmakers questioned the company's business model, risk controls, platform incentives, and relationship with market makers paying for order flow. The broader financial industry also faced growing scrutiny because the event revealed how much of modern retail trading had become dependent on complex infrastructure that most ordinary investors did not fully understand while using simplified mobile trading apps. Although Robinhood survived the crisis and continued operating afterward, the event permanently damaged trust among many users who originally viewed the platform as a symbol of democratized investing. More importantly, the meme stock episode exposed how frictionless mobile trading, social media-driven investing behavior, and hidden market infrastructure could suddenly collide in ways capable of generating real systemic stress across modern financial markets. The Robinhood crisis ultimately became much larger than the controversy surrounding a single trading app because it exposed deeper structural weaknesses underneath modern retail financial markets. For years, financial technology companies had aggressively pushed the idea that investing should become frictionless, instant, mobile-first, and constantly accessible to ordinary retail users. Robinhood became one of the strongest symbols of that movement because the platform successfully removed many of the barriers that previously slowed retail participation inside financial markets. Millions of younger investors entered stock trading for the first time through systems designed around speed, simplicity, and nonstop engagement. However, the meme stock crisis revealed that simplifying the user experience on the surface did not eliminate the enormous complexity operating underneath the market itself. Behind every app-driven trade still sat clearinghouses, settlement obligations, collateral systems, market makers, liquidity requirements, and financial risk protections built to prevent instability during periods of extreme volatility. The problem was that retail trading behavior during the pandemic-era meme stock frenzy started scaling faster than portions of that infrastructure could comfortably absorb in real time. At the same time, social media-driven investing communities had created a completely new environment where millions of retail traders could suddenly move together through highly volatile positions with unprecedented speed and coordination. Robinhood did not collapse financially after the event. The company survived, continued operating, and remained an important player inside retail investing markets afterward. But the January 2021 crisis permanently changed how regulators, brokerages, investors, and financial institutions viewed frictionless mobile trading and app-driven retail market participation. The event exposed how quickly modern financial systems could experience stress once massive online communities leveraged options trading, social media momentum, and simplified mobile investing platforms all collided simultaneously inside extreme market volatility. The story was never simply about meme stocks or retail traders fighting hedge funds. It was about a modern financial system discovering that technology had dramatically accelerated the speed of retail participation, while parts of the infrastructure underneath the market still operated on much older assumptions about how quickly risk could spread during periods of extreme volatility.